Welcome to lecture 14 of business taxation. In this video, we are going to discuss a new topic, which is capital and revenue expenditures and capital and revenue receipts. So let's move towards the contents. We will first discuss capital expenditure. What are capital expenditure? What are the signs of capital expenditure? And then we would see revenue expenditures and what are different tests that we can perform to check whether an expense is a capital expenditure or revenue expenditure. So we will do the same for the capital and revenue receipts, but first we would start with the expenditure. But before we dive into the lecture, let's first understand why do we need to explore this topic. Why do we need to learn this? You must understand that the topic that we are soon going to start is income from business or business taxation. So how do we levy a tax on a business income? How do we calculate? For salary, we know a fixed amount of a salary that an employee is receiving. For rent, we do the same. But in case of a business, what we need to do is we need to first calculate revenues, that is sales. So we need to make an income statement. Then we need to deduct all the expenditures, and the final amount that we get would be the earning before, let's just say, taxation, if we deduct the interest expense also. Then we would calculate a tax on this amount. So let's just say our expense was revenues were 1000 rupees, expense was 500. We would be left with the 500 rupees of earning before tax. And if, let's just say, tax is 30%, then 30% of this 500 rupees would be 150. So we calculate tax on this EBT, right? To calculate this tax, we need to know revenues, we need to know expenditures. So for example, if a business bought a machinery, right, would this machinery be deducted as an expense or not? Right, we have two kinds of cash outflows. One is the expense and the second is the expenditure. The expenditure is a long term. We report it in the balance sheet. For example, in case of machinery, in case of land, in case of building, we do not report all the amount in the income statement of that year. Otherwise, we would always have a loss in that specific year. So what we do is we record that machinery in asset side of the balance sheet, and we just deduct depreciation over here. But anyhow, what I mean to say is, which expense should this expense be deducted in the income statement or it should not be deducted? Similarly, let's just say we bought a company, right? Or rather, this is again an expense. So let's just say we sold some kind of a copyright, right? We have made a movie or a song, or we have written a book, and we have sold the copyrights of that book to another firm or another person. So we are receiving certain cash flows, inflows. That is, should we record that revenue in income statement or not? For tax purposes, right? This is what we are discussing, is from the tax purposes. So we start with the expenditure, this part. What expenditure should be deducted from revenues to calculate EBT so that we can calculate taxes? Okay, so income tax is only on revenue receipts, not on capital receipts, right? So whatever amount that we are receiving is the income tax that we would have to pay is it would just be on the revenue received, and it would not be on the capital received. So we need to distinguish between revenue received and capital received. The amount that is received by a company whether it is a revenue received or a capital received. If it is a capital received, we will not charge tax on that. If it is a revenue received, we will calculate tax on that. Similarly, revenue expenses are deducted only from the revenue, as we saw have shown you in this slide. So whenever we deduct the expenses, so we would just deduct the revenue expenditure over here and not the capital expenditure. But the issue is, how do we know whether an expense is a revenue expense or it is a capital expense? So there are certain tests that we can perform. There are certain litmus paper tests or certain clues that we can have, certain rules that we can follow to distinguish between capital and revenue expenditure. The first one is purchasing an asset. So when we purchase an asset, there is an expenditure, right? Should this expenditure be deducted from revenues while calculating our EBT or not? That would depend whether the asset is a fixed asset or a floating asset. If it is a fixed asset, then it would not be deducted. It would be a capital expenditure. If it is a floating asset, then it would be a revenue expenditure, right? So I repeat, we need to first distinguish between fixed asset and floating asset. If an expense is incurred on fixed asset, then it is a capital expenditure. If it is incurred on a floating asset, then it is a revenue expenditure. So how do we define fixed assets? An asset purchased for the purpose of keeping and earning profit. So we buy machinery. Why do we buy machine? Let's just say we buy it. In this case, we buy it for the purpose of keeping in the business and production purposes, and then we would sell the final output, the final product in the market. So then the expenditure that we are incurring is a capital expenditure. So our purpose was to keep the asset. Similarly, if we bought an asset which an organization purchases for resale, right? For example, if there is a showroom, a car showroom, they buy cars for resale purposes, right? Then for them, those cars are floating assets. But let's just say an organization buys a car for the purpose of using it in the organization, or for the purpose of let's just say so they can use it as it is a taxi services company. It is a Uber or Careem or some other taxi services, although Careem and Uber do not directly buy cars, but let's just say they do. Or there is some other firm that let's say Davo service, they would buy a bus not to sell that bus again to another individual, but the motive would be to buy it and then use it to earn profit. So in that case, that asset, that bus, would be a capital expenditure. So the item is same. It doesn't matter what the asset is. It is the motive behind buying that asset. Okay, so I hope this would make sense. Let me clear this. Okay, fixed asset is an asset purchased for the purpose of keeping and earning profit, and it is not for the resale purpose under normal course of business. This is what we have discussed. But in case of floating asset, it is an asset purchased for resale purpose, either in same shape or in different shape. So we can purchase a raw material and then convert it into finished product and then sell the finished product. Again, this purchase of the raw material would be floating asset. But if we again, if we bought raw material and directly sold that raw material, again the purchase of this raw material over here would be a floating asset. Okay, period of benefit. Another test that we can perform is to distinguish between capital and revenue expenditure is the time period that this asset would give us the benefit. So if there is a continuous benefit, then that is a capital expenditure. So what do we mean continuous benefit? It means that the benefit would be for multiple time periods, right? Normally it is more than 1 year. Then we would say that that is a capital expenditure. So again, buying a machinery or buying a building would have, for the purpose of keeping them, would have uh, benefits coming over the years, not just that specific year. Similarly, if there was an asset that we bought whose benefit is less than 1 year, then that would be a revenue expenditure. So normally in case of advertising expenditure, let's just say the organization places some kind of a fixed asset which cost a lot, and that asset would remain there for quite long time of periods. For example, they have built a monument in some place, so that monument won't last for just 1 year. It would be there for a couple of years. Or they have placed an advertising signboard kind of a thing within their premises, and that signboard would last for a couple of years, then that is a capital expenditure. But the day-to-day advertising expenses would be a revenue expenditure. Then comes the initiation of a business. So any expenditure made to start a business are capital expenditure. So any legal fees paid to the advisor for the drafting of memorandum or article of association of a company would be capital expenditure, because this amount is paid to initiate the business. So initial expenditure are treated as capital expenditure because these are not incurred to earn profit, rather to install the machinery to earn the profit, right? Then we have extension of business. So again, any expenditure that is incurred to extend the business would be categorized as capital expenditure. So let us say a company wants to extend the business, and in order to raise more capital it issues more shares. So if it is going to issue some more shares, they are going to do some kind of advertising expense to motivate the investors to invest in that company, to buy the shares of that company. So in this case, the company is not initiating, it is already there, but this advertising expense is being incurred to extend the business. So this advertising expense would be considered as capital expenditure rather than revenue expenditure. Then we have a principle of earning capacity. So it says if earning capacity of an organization is increased, then that expense would be called capital expenditure. So in regard to machinery, there are two kinds of expense that a company can make, right? One is to replace that whole machinery and install a new one, and the purpose is that this new machinery would increase the production, increase the output, increase the efficiency. So then we would call it a capital expenditure. But if we are just overhauling the current machinery or replacing just a few parts of that machinery, then or doing a repair or maintenance work on that machine, then that expenditure would be treated as a revenue expenditure, because it isn't to increase the capacity, but it is a normal routine repair and maintenance work. Let us discuss some examples. So legal expense incurred in raising a loan to start a business. What do you think this would be? Would this be a capital expenditure or a revenue expenditure? Because this legal expense is being incurred to start a new business, so according to our discussion where we we said any expenditure that is incurred to initiate a business would be capital expenditure. This is an example of a capital expenditure, right? Because it is for the starting of a business. Amounts spent for the construction of a building, any amount that a company is going to spend for the construction of a business would be treated as capital expenditure. Why is that so? Because the first principle that we discussed was fixed and floating asset. This is mostly the principle that we need to look into. What was the definition of fixed asset? The asset that would give us the benefit for multiple years. In this case of the building, it is going to give the benefit for multiple years, so it would be categorized as fixed asset, and hence any expense that is incurred on fixed asset would be counted as capital expenditure. Advertising expense normally incurred. So in this case, although in previous example we discussed the case of advertising expense, which is incurred for issuance of the shares, but in this case it is clearly mentioned that these advertising expenses are incurred for normal day-to-day expenditure of a business. So in this case, these advertising expenses will not be capital expenditure, rather they would be called revenue expenditure, because these are normal business advertising expenditure that are incurred for day-to-day activities, and its benefit would usually last within a year. Cost of affixing a signboard at the business place. So this signboard that is installed at a business place would remain there for quite a couple of years. Again, it is an example of a fixed asset, right? And hence we would say that this expense is a capital expenditure. So we are going to receive continuous benefit. The second point which we discussed to distinguish between capital and revenue expenditure was the period of benefit. So in this case, this signboard case, we are going to receive the benefit for multiple years. Transportation expenses paid to purchase stock in trade. So what is stock in trade? We purchase a raw material, right, or any inventory. Is inventory something that we do that would last for a couple of years, or it is the routine purchases that we make? So it is a routine purchase that we make, and the asset that we are purchasing is a floating asset. Why? Because its benefit would last for multiple years. Rather, it would be sold off most probably in the same year. So the transportation expense would again be called revenue expenditure rather than capital expenditure. Royalty paid for acquiring a copyright. So what is copyright? Let's just say a singer records a song, or a producer or director makes a movie, or an author writes a book. So the right of that book remains with the creator of that content, that intellectual property. So sometimes these intellectual properties are sold, right? Let's just say the author selling his book, or the director selling the movie. They would receive a royalty for buying of that specific content. So if they are going to buy it, the copyright of any intangible asset, then it would be again called a capital expenditure. Legal expense incurred in drafting a partnership deed. So this in this case, it would again be capital expenditure because the amount is being spent on the either the initiation of the business. Obviously, we would write the partnership deed at the start of the business, or when we are expanding the business and we need more partners. So in this case, this expense would be categorized as a capital expenditure. So in next video, we are going to discuss the capital and revenue receipts.